When the US government warns of a recession? When the Federal Reserve attributes it to rising tariffs? When Warren Buffett says tariffs could erode the value of the US dollar? When the head of Bridgewater Associates claims the global monetary system is unraveling? When bond market titan, PIM, warns of a mass sell-off in US debt? You have to wonder, is America heading for a financial game over? Hi everyone. Welcome to Stewardship Finance Academy. This is a channel that builds confident investors. What happens if US stocks, bonds, and the dollar all fall at the same time? Could we really be looking at a full-scale collapse in the next 3 months? It's a chilling scenario, but we've seen something like it before. Remember the 2008 financial crisis? Banks failed. The stock market crashed. Trillions in wealth evaporated in a matter of weeks. It felt like the end of the system. But did the US actually collapse? No. Despite the panic, the dollar didn't become worthless. Why not? What saved the US financial system? It comes down to one critical fact. Every country's treasury depends on 2 core assets, gold and foreign exchange reserves. And most of those reserves are held in US dollars. Over 80% of global trade is settled in dollars. Because quite simply, most of the world's currencies are not trusted. Take India, for instance. In 2023, it faced real difficulty importing gasoline. Not because of a supply shortage, but because it didn't have enough US dollars. Or look back to the 1997 Asian financial crisis. Thailand and South Korea saw their national currencies collapse because global markets lost confidence in them. Their recovery depended on one thing: access to US dollars, which helped stabilize their exchange rates and halt the financial spiral. That's why nations hoard dollars. Countries like China, Saudi Arabia, and Japan stockpile US dollars. Not as physical cash, but by purchasing US Treasury bonds. These bonds help hedge against inflation while preserving the utility of dollar holdings. Why not just hold the cash? Because the US dollar, while powerful, loses purchasing power over time. In fact, it's depreciated by about 30% over the last 20 years, largely due to continual monetary expansion by the Federal Reserve. If you hold only cash, your wealth erodes quietly but steadily. Treasury bonds, by contrast, pay interest, which helps offset that loss. This is exactly why countries like China, which earns billions through trade with the US, plow much of that income right back into American bonds. It's not just about yield, it's also a strategy to avoid the appreciation of their own currency, which would hurt exports. Currency appreciation can be devastating for export-driven economies. Take China, for example. If it were to hoard US dollars without reinvesting them, the value of the Chinese yuan would soar. It sounds good at first, until you consider the impact on exports. Suddenly, Chinese products would become significantly more expensive on the global market. A pair of sneakers that once cost $100 might now sell for $150. Global buyers would turn away, factories would shut down, jobs would vanish. The economy could spiral into crisis. It's a scenario China wants to avoid, and one Japan knows all too well. During the 1980s, Japan earned enormous sums of US dollars by exporting cars, electronics, and appliances. In response, US policymakers pushed Japan into signing the Plaza Accord, an agreement that forced the yen to appreciate, nearly doubling its value from 240 to 120 yen per dollar. The impact was immediate and brutal. Japanese exports became dramatically more expensive. Demand dropped. Factories closed. And powerhouse brands, like Toyota and Sony, began relocating operations to China. Japan's once booming economy entered a period of prolonged stagnation that would last for 3 decades. The lesson was clear. When a nation accumulates too many US dollars but fails to reinvest them, its own currency strengthens, pricing its goods out of global markets and triggering economic decline. This is exactly why countries continue hoarding US dollars and why they reinvest in US bonds. Foreign exchange reserves are typically held in a mix of US dollars, Treasury bonds, and gold. Among these, bonds are especially critical, even when they offer relatively low returns. Like US Treasury bonds paying 2% compared to Brazilian bonds offering 12%, why choose the lower yield? Because stability matters more than yield. 12% return means nothing if the underlying currency collapses. Brazil's currency, for example, can swing wildly, dropping 20% to 30% in a short time, which can completely wipe out gains. In contrast, US bonds are seen as a haven. They're backed by the world's most trusted currency and the largest economy, one that issues its own debt in dollars. So that matters, because the US can print the currency in which it owes its debts. Countries like Ukraine can default on dollar-denominated loans. The US cannot. It simply creates more dollars. This is the heart of dollar hegemony. The global economy, knowingly or not, helps finance US military strength and economic dominance by purchasing US debt. People often talk about de-dollarization, the idea that currencies like the euro or China, renminbi, could dethrone the US dollar. But here's the reality. The world isn't hoarding euros or yuan. still buying gold, and no country holds more gold than the United States. Even if nations start reducing their US bond holdings, gold is still priced in dollars, which means any move into gold still reinforces dollar dominance. In fact, the US could, in theory, engineer a global financial crisis. By printing vast amounts of money and recovering faster than other countries, it could drive capital right back into US markets. We've seen this play out before. So while there are loud calls for alternatives, no other currency or bond system comes close to matching the dollar's global reach and institutional trust. For now, and likely for the foreseeable future, the world remains tightly bound to US dollar hegemony. But that raises an unsettling question. Why are financial giants, the Federal Reserve and even the US government themselves, sounding bearish about the American economy? It's not because they want the US to fail. Rather, it's because they're positioning themselves to benefit from global disruption. What we're witnessing may not be mismanagement, but strategy. A controlled financial crisis can shake markets, erode personal savings, and allow dominant players to consolidate power. Wealth doesn't disappear in these moments, it moves. And more often than not, it moves upward. In this sense, what's happening could be seen as a kind of financial heist, one that transfers the wealth of everyday people into the hands of institutional capital. The same tactics used to sideline Japan's economy in the 1980s may now be returning on a global scale. Back in the 1980s, the Plaza Accord forced Japan to let the yen appreciate, effectively doubling its value. The consequences were immediate. Japanese goods became too expensive to compete internationally. Exports plummeted, factories shut down, and giants like Toyota moved operations to China. Japan's economy lost 3 decades of growth. Today, the US applies the same pressure, but through a different mix of tools: tariffs and exchange rate manipulation. Tariffs increase the cost of selling goods in the US, while currency appreciation cuts into exporters' profits. Take a Japanese firm making $1 million from exports. After tariffs, that might fall to $700,000. Then, if the yen strengthens, that revenue shrinks even more when converted back to local currency. The result? Exporters fail, factories close, workers lose jobs, and economies crash, just like Japan. This is America's hostage tactic. If a country refuses to buy US bonds, it risks being hit with tariffs, currency pressure, or even asset freezes, all of which can push its economy into recession or collapse. Russia offers a recent example. After the US froze $300 billion of Russian assets, the ruble lost 30% of its value. Without access to US dollars, Russia was effectively locked out of global trade. The ruble fell even further on the black market, wiping out wealth and crushing purchasing power. Despite increasing calls for de-dollarization, the global financial system tells a different story. Saudi Arabia still sells oil in US dollars. China, even as it offloads long-term US debt, continues to buy short-term Treasury bonds. Why? Because the stability of a nation's currency often depends on its reserves, and those reserves are typically backed by US debt and gold. If US bonds collapse, the value of foreign-held reserves collapses too, dragging down currencies across the board. The US leverages this dependence to ensure other nations keep absorbing its debt. It's a built-in system of global demand for the dollar. And while the US dollar has depreciated, that's actually by design. The weaker dollar makes America's debt cheaper to repay in real terms. At the same time, when global stock markets crash, asset prices drop, and capitalists sitting on liquidity can swoop in to buy American companies, real estate, and stocks at bargain prices. This is the cycle of dollar hegemony. The US triggers or accelerates global crises, prints money to recover faster than the rest of the world, and then attracts capital back into US bonds, dollars, and assets. Countries that resist this cycle risk the same fate as Japan, or worse, Russia. Is this just a currency war between the US and the rest of the world? When countries like Japan, Thailand, and Russia watch their wealth vanish and can't stop it, who's next? If governments can't protect their own economies, shouldn't you be thinking about how to protect yours? Will you stand by in the next crisis, or step up and take control? Start preparing now. When you see dark clouds, don't pray. Buy an umbrella. You don't need 20 strategies. You need one system that works across the board. In stocks, gold, Bitcoin, even Forex. If you haven't learned this system yet, don't wait. Click the link in the video description. Join our investment class. It's 100% free for now. No $100 sign-up fee, no hidden costs. Its spots are limited, and this offer won't last. Some might say, I won't buy US bonds. I'll buy gold instead. That'll devalue my currency and break free. Sure, that sounds like a plan. But here's the trap. You still need US dollars to buy gold. So when a country converts its reserves, US dollars and bonds, into gold, it's shrinking its dollar holdings. That's not a problem in theory, till you realize gold is up 68% in just 1 year. Which means your country now needs 68% more dollars just to buy the same amount of gold. And here's where it gets worse. You stop buying us bonds and go all in on gold, the US can respond with tariffs, making it harder for you to earn dollars in trade. Now you've got a dollar shortage. Then Wall Street steps in, shorting gold and driving the price down in your country. It can't defend gold prices without dollars to back the market. Gold collapses. And just like that, you lose both your gold and your dollar reserves. Your wealth has been invisibly siphoned back to the United States. Sound extreme? It's already happened. After the 2008 financial crisis, the US printed trillions and recovered faster than any other economy. Other nations, fearing dollar instability, rushed into gold. Prices soared 177% from 2008 to 2011. Wall Street didn't sit back. Goldman Sachs released bearish gold reports, warning of a 30% price drop, injecting fear. Hedge funds began massive gold sell-offs, causing a sharp 10% plunge in just 1 month. Global central banks like the Swiss National Bank panicked and dumped reserves. Then came the knockout punch. In 2012, Wall Street executed 300 tons of short orders on gold in a single minute.
Ow.
These weren't physical holdings, they were leveraged futures contracts backed by tiny deposits. This triggered a market crash, and gold plummeted 45% from its peak. The outcome? Countries that tried to escape the dollar through gold were forced to sell at the bottom just to get dollars back. Meanwhile, US capitalists shifted their profits from shorting gold straight into long positions on US bonds and dollars, laughing all the way to the bank. This isn't a one-time trick, it's a repeating cycle. And unless nations build a true, coordinated alternative to the dollar system, they'll keep getting pulled back in. The US plays the game. Wall Street sets the rules. And the world keeps paying the price. Let's cut to the core. The most important takeaway is this. The US is using tariffs and triggering a global stock market crash to force currencies around the world to appreciate. And now, countries are cornered with just 3 options. Do nothing. Let your currency keep rising. It's just like Japan did and risk decades of economic stagnation. Buy US bonds and submit to America's financial dominance. Buy gold only to see its price manipulated and end up crawling back to US bonds anyway. That's the trap. And here's the game plan behind it. The US can deliberately trigger a financial crisis. Like in 2008, the Federal Reserve steps in and prints unlimited dollars, claiming it's to save the economy. But who gets the first access to this fresh money? American capitalists. They borrow at near zero interest by distressed US assets and ride the rebound. As the US economy recovers faster than anyone else, global capital floods into US bonds, dollars, and stocks. Meanwhile, assets everywhere else keep collapsing. Then, Wall Street cashes out at the top, and with deep pockets, they go global, buying up the world at fire sale prices. In the end, the US rises from the ashes. Global wealth flows back into American hands. And here's the hard truth. This cycle works because there's still no true alternative to the US dollar. Even gold, still priced in dollars. Even US bonds, still settled in dollars. And when a crisis hits, only the Fed can print money without collapsing its currency. No other country has the foreign exchange reserves or global trust to pull that off. If they try, they risk turning their money into worthless paper. So, what happens next? Unless the world builds a real alternative, and fast, this cycle will keep repeating. Once again, American capitalists will walk away as the biggest winners. Want to understand how to position yourself before the next cycle begins? Subscribe to our channel to receive the latest updates. People often ask, what can we actually do to avoid this crisis? And the answer is brutally honest. When even governments and trillion-dollar funds can't escape the storm, what chance does a single person have? But that's exactly the point. When you're small, you're nimble. You don't need to steer an oil tanker, you're a speedboat. While big investors are stuck waiting for clearance, we can act instantly like mice weaving between elephants. This is why we don't hold long-term positions blindly. Take gold, for example. I know how this game works. The US pumps up gold prices to attract the world, then shorts it and crashes it to force money back into bonds. But I'm not here to resist the system. I'm here to profit from it. We bought gold and Bitcoin last year, anticipating geopolitical chaos and currency depreciation. When gold surged, so did our returns. If the US starts dumping gold, we are ready to exit. We don't need to wait for boardroom approval. We entered US stocks early last year, but by year-end, cashed out before the market tumbled, rotated into Hong Kong tech stocks, which doubled at its peak, while others were still clinging to their sinking portfolios. While some people are still asking, what should I do with my losses? We are already looking for the next setup. We don't get locked in. We observe the field, move fast, and strike where the odds favor us. Stay light. Stay informed. Move first. That's how you survive the next crisis, not by being the biggest, but by being the most adaptable. We follow trends, we stay agile, and most importantly, we have a plan. Prepare before opportunities appears, so we can act as they emerge. But if you haven't learned this system yet, if you're still trying to figure it out as you go, you will always be behind the curve. That's why I urge you, start by understanding investment mindset and our methods so you can apply them independently. Don't expect me or anyone else to carry the weight of your financial future. If you haven't watched the stock investment class, do it now while it's still 100% free and comes with bonus resources. Because once it's gone, it's gone. It's this entry point, and you might be waiting years for the next real bull market. Oh. The window doesn't stay open forever. Still have questions from today's video? Go back and watch our other videos posted recently. Without that foundation, you might think today's insights came out of nowhere. If you're serious about mastering this, start from the beginning. The world isn't slowing down, it's only getting more chaotic. And in this storm, waiting for clarity is the same as choosing inaction. Prepare now. Hit subscribe and turn on notifications so you don't miss a thing. If today's video helped you in even one meaningful way, then my work has been worth it. And if you believe others could benefit too, share this video selflessly. To all of you who watched to the end, I sincerely hope you reach true financial freedom. Got questions? Drop them in the comments. I'll see you in the next video.